Welcome to Second Take, the show that focuses on the issues behind the news. Glencore has entered a long-term silver streaming agreement with Anani Investments and Wheaton as part of its debt reduction plans. Mining Weekly editor Martin Creamer joins me in studio to tell us more. Hi Martin.
Hi Tracy.
So why did Glencore enter this agreement, and is this an increasing trend in the mining community?
Yeah, well, I've heard streaming being uttered, but probably only for 2 years now. Previously we see a hedging, where you'd actually sell the gold forward, or you'd sell the silver forward or the precious metal forward at a fixed price, but at least you'd get it out of the ground. But now things have become so dire in the mining industry that you sell what's in the ground and you pre-sell it. But what has happened with Glencore, it has responded to its shareholders who wanted it to reduce its debt. And I must say it is moving like lightning. I'm sure they're working around the clock to do this because, not only have they raised equity of 2.4 billion and they've suspended dividends for another 2.3 billion or whatever it is, but they've really given analysts a lot of confidence that the momentum that they've created with reducing debt is going to result in debt coming down fast. And we saw now, just before they gave their production results, they also gave a corporate update where they indicated they'd done this deal with Wheaton, which will give it like $900 million up front. That's how it works. Before this comes out of the ground, you get an amount, and then Wheaton will continue to get a percentage of ounces thereafter. I think it's like 2/3 or something like that. We've seen a lot of these deals done, and we know that Glencore is going to do another one before the end of the year. So, and I did listen to Glencore earlier this year, and Ivan Glazenberg responded to analysts, and they asked him whether he would consider streaming as part of his option to cut debts, and he said, yes, we will consider streaming, and of course now they're doing it. And I think there have been something like 50 of these deals done, but normally by more desperate companies, not companies as big as Glencore, which are in a far better position, but which are under request from their shareholders to reduce risk by bringing their debt down to about $10 billion, or by $10 billion.
And Glencore has been working hard, as you've said, to reduce its debt. And what has it done to, achieve these results?
Well, I think it's the many steps have come forward, and streaming was just one of the many steps that they've taken. And it indicates a good response to me to concern by shareholders. If your shareholders are that concerned, even though I don't think Glencore was as concerned, it had a plan, it was going forward with it. It knows that it's not only a miner, it's also a marketer. It's got a good stream of ongoing cash flow. It still responded. It said, okay, well, we'll bow to your requests. And so across a broad front, they started moving, and including now we'll see on the agricultural division, they're working on another deal where they can get that debt down, and by all accounts they will do. So it shows some responsive action by the management, and we know that people are calling for debt reduction across the board in mining. Shareholders are nervous, and they don't want added risk. And they've also, a lot of the shareholders, not in Glencore's case, but in other cases, they've complained about capital allocation, which they are now beginning to call capital misallocation. And some of them, as we heard at the Joburg and Durban recently, they are concerned that chief executive officers have really come up a different route. They've come up the operational route, not the financial route often. So they've reached the top often because they're very good at extracting ore and seeing that it gets to surface and it gets processed. Then they get into a position of being a CEO, and suddenly they've got to start allocating capital. They also are given certain shareholder options, which means that if they do deals and make the company bigger, the share price rises, and if the share price rises, they get a bonus. Now, there has been a lot of talk about not doing it this way in the future, rather give people operational bonuses, or if they reduce unit costs, then they get a special, a lot of money coming into them. And if they achieve other operational metrics, that they get this. But they want to try and move them away from the share price metric because they feel that the shareholders haven't really scored. If you look at the public PricewaterhouseCoopers, they analysed 35 companies on the Johannesburg Stock Exchange, and if you excluded Kumba, it meant that shareholders got like 3% of the pie. Actually, employees did quite well, getting like 45% of the pie. And they're saying this is why investors are moving away from mining. Because, you find investment bankers do well. They've been making a killing. CEOs have made a ton of money. And, even, fund managers have made their money. Employees have made their money. But the segment that has been starved of a return is a shareholder, which, of course, is also us, because it's our pension fund, it's our provident fund to a large extent. So it's not good for the sort of investor community. They're not getting a fair share. Everybody else is taking things out too fast.
And Glencore has reiterated its earnings expectations for its marketing division. How did analysts respond to this?
Yes, there was also concern, aren't you overstating your marketing cash flow? Aren't you thinking, well, you're going to get more out of that? Times aren't good. Are you going to be able to sell these commodities? And of course, Glencore's in trading, and it knows that business very, very well. And it was saying, no, we will get them. But people were still skeptical. And now you could see a lot of the analysts saying, no, this marketing is the cash cow that they've said it hasn't been overstated. So I think to a large extent, the credibility of management, Glencore management, has been very quickly restored. And I'm just wondering whether now pressure won't be put on other big multinationals. You wonder what sort of pressure could now be put on Anglo American. You see a lot of sell notices coming out from the analysts. Liberum Capital is convinced that you must sell Anglo, you must sell it fast, because they're worried about the iron ore price, which they think will go down to about $30 a ton, $35 a ton, around about there. And they calculate that the break even for Kumba iron ore is $45 a ton. So they're saying also in South Africa, you can't just say, well, that the price of iron ore has gone down to 35, therefore we're getting rid of X number of people. You can't do that. So there's a period of bleeding, and they worried that this will hurt Anglo very, very badly. So they're saying sell, sell, sell. And you can even see pressure starting to come onto BHP Billiton, Rio Tinto. The analysts are starting to put out sell recommendations. So that could put these companies under pressure. I think that Glencore has been fortunate. Their shareholders, gave them the indication quickly that they must move, and they did respond, and their debt was higher possibly, but they've got the benefit of this trading situation, which these other companies don't have. And I'm wondering if the iron ore price does fall to that, it will put huge pressure on companies like BHP Billiton and Rio Tinto. And looking at the volume, the tonnage of iron ore in China at the moment, the calculations are that at the current use of that iron ore stockpile, it will only be depleted in 6 years. That doesn't augur well for the iron ore price. And I can see alarming messages coming out from analysts. They're even putting themselves on video now so that they can be more convincing, and they're telling you, this is what's going to happen. Please be aware that we've warned you about this. And so I'm sure it's having an impact on the share prices of particularly Anglo American, also BHP Billiton and Rio Tinto. So these big companies, they're nicely diversified, but the nature of the sentiment at the moment is so bad, the level of concern is so high that they're having to do things that one wouldn't have expected. But I think Glencore is lucky that they've been able to move fast, and I think they've probably relieved the pressure off themselves, which now might be transferred to some of their peers. But I think we'll just have to watch that space.
Thanks, Martin.
It's a great pleasure, Tracy.
That's the Second Take show for today. Join us again next time for more news analysis.